I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Gary Savage, President and CEO of SmartMoneyTrackerPremium.com. Welcome back to the show, Gary.
Thanks for having me on again, Jim.
It's an interesting day in that most of the boards are solid green and not. Usually we'll see something going down somewhere, but it looks like it's positive all around.
Yeah, that's been my thesis for quite some time, is that everything would go up together.
Gold going up a little bit at a time. It's not going up at the rate some people expected. Does that surprise you?
Well, gold may have to trade sideways for a bit. It's at a triple resistance zone. There's the bear market trend line from the top in 2011 comes in right around 1380, 1400. The 38% Fibonacci retracement of the bear market is, I believe it's 1381 if I'm not mistaken. And the 2014 yearly cycle high was at 1391. So we've got a bunch of resistance zones there. It's possible that gold is just not going to go through that on the first try. It may have to go sideways a little bit to build up enough pressure to break through that. But I think it will break through it, but we may be stuck for a little bit while it builds up enough buying pressure to get through that resistance.
Is it the same picture for silver?
Same thing for silver. Silver will follow and magnify the moves in gold. And if you look at a long-term weekly chart of silver, gold did get above its 200-day moving average or 200-week moving average, but silver is kind of stuck right at that 200-week moving average. It's been trading kind of on either side of it, so kind of the same thing. That's a big resistance zone, and it's probably just not going to go through it easily on the first try. So, just another point in favor of maybe a consolidation that could maybe even last the whole month of August.
Little more patience when it comes to silver.
Yeah, I think for the whole metal sector, the whole sector is stretched quite far above the mean, and by that I mean the 200-day moving average. Last time I looked, the mining stocks were about 65% above the 200-day moving average. So what I suspect is probably going to happen, unless the dollar falls really hard here in the next couple of weeks. As long as that doesn't happen, then what I suspect is going to play out in the metals is we may get like a triangle consolidation in gold in the month of August, and then that would set up the big move that everybody is looking for, but it wouldn't happen until September and October.
Right. And the triangle consolidation means what?
Well, it's just oftentimes those are continuation patterns. When price gets a little stretched too far above the mean, that usually takes out the institutional buyers, retail traders, emotional traders. The further price gets above the average, the more bullish or the more bearish they get. But generally, a smart money, an intelligent institutional investor, they tend to get nervous when price gets stretched really far above the mean. So, with gold and silver and especially the miners all quite far above their 200-day moving averages, you're probably taking away the big institutional money. They're probably going to sit on the sidelines until that gap between price and the 200-day moving average shrinks a little bit. So without the institutional investors, we just may not get that big surge higher yet. I think we are going to get it, but we may have to trade sideways, and one typical pattern that will play out is you'll get a kind of a triangle pattern where the price will just bounce back and forth for several weeks, And that just allows the overbought conditions to work off. It allows the moving average some time to catch up to price. And then when the breakout comes, then you can get that big move. But it just kind of frustrates everybody because they want the big move now. We made some good money in the last month. They want it to continue. But often it just doesn't. We just have to consolidate and back and fill for a little bit before the next big move can happen. I think that's probably what's going to play out.
Should people be looking at buying gold right now, or should they hold off a bit?
I think you should hold. If you're comfortable with holding through a minor drawdown, you could go ahead and buy. Maybe you buy at the bottom of the channel. Maybe somewhere, down around the, I'm going to say 1320 to 1336 level you want to buy. Maybe when it gets back up to the 1360 level, you want to stop buying. You want to wait. And then at some point, I think we get the breakout, and we'll go through that triple resistance level at that 1380 to 1400 level. We'll go through that, and I think we're going to get to at least close to 1500, maybe even as high as 1550. But that would be later in the fall, maybe end of September, early October, and that's where I would look for a more substantial top in gold, and then a longer correction, something that lasts 6-7 weeks.
Oil seems to be stuck in the $40 range. Is it going to stay there?
Well, I think oil is probably the place where you're going to get the big trending move that everybody is looking for. I think it's most likely to happen in energy. The reason I say that is that it looks to me like oil has completed its intermediate cycle low. It bottomed right at the $39, $40 level. If you pull up a 30-year chart or a 40-year chart of oil, you'll see that $35 to $40 level was a major resistance zone for many years, couple decades. Then when it finally broke through that in the early 2000s, then we went up and we made that top at 147. Then we had the bear market. We broke below that $40 level, got down to about 26. We put in the 3-year cycle low back in February. We regained the 40, and now we've had an intermediate degree correction that many people are assuming that the bear market is resuming in oil, and it's not. This was just a profit-taking event. We got up to a little over $51. That was a big move from 26 to 51, big percentage move. It triggered some profit-taking. Again, we got stretched quite far above, the mean, put in, a big move. I think that was about an 70-80% move. Kind of took the institutional investors out of the market. They didn't want to buy anymore until price corrected, which it has. And, not coincidentally, oil went right back down and tested that multi-decade support and resistance zone at right around $40. I think we got down to about 39. And it looks to me like that's where we put in the intermediate cycle low. Now, I'm going to say that the vast majority of people are still focused on what they perceive to be the fundamentals, and they are not the fundamentals. The fundamentals have already changed. We've already eliminated a lot of fracking companies have gone bankrupt. The fracking wells, those things are mostly tapped out within about a year. So if you're not constantly drilling in the shale, production is going to go down very quickly. So we already have in place the conditions for supply to drop, and what I think is happening is that the global economy is starting to accelerate again. Most people are stuck in that bearish view that the economy is going into recession, and it is just not. I've been traveling all over the western states for the last 2 months, and literally everywhere I go, there are help wanted signs everywhere. So, in the United States, for sure, the economy is starting to accelerate, which is exactly what you should see during an inflationary phase, and that is my expectation, that we're going to have an inflationary phase over the next 4, 5, 6 years. I suspect that Europe is also bottomed. If you look at the stock market indexes, all of the European indexes, they made their intermediate cycle low. That low held above the February low. So we've got, higher low or double bottoms in all of the European indexes. So I'm confident that the European economy is starting to turn around. And that's just what happens when central banks print trillions of dollars. It's got to go somewhere. And some of it does eventually get into the economy. The problem with that process is that it creates bubbles. And I think it's going to create another bubble here, but not in the near future. I think we're probably 3 or 4 years out. We'll create the next series of bubbles, and then, we'll have another mess to deal with. But right now, I think we're starting an inflationary phase in everything, and that's why the price of everything is going up together.
We'll have more with Gary Savage right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the 4th largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Gary Savage. Gary, the German DAX has gone up 20% since its low. Is that a sign that Europe's economy is bouncing back, as you mentioned just before the break?
I think it is. All the indexes, the FTSE, the CAC, the DAX, they all held their February lows. None of them dropped below it. They all bottomed above that, and they're all moving higher again in new intermediate cycles. The bounce out of the intermediate cycle here in the U.S. has been, exceptionally violent. And I've been saying this, for the months that we've been talking together, that the U.S. stock market was not entering a bear market, that the indexes would move to new highs. The sentiment levels, I know some analysts, they just to be blunt, they're wrong. They are looking at sentiment levels, and they're looking at the wrong levels. The robo ratio is the ratio of retail trader call to put buying, and retail traders are still buying way, way too many puts. So the average retail trader, the guy that's, consistently on the wrong side of the market, he's still convinced that stocks have started a bear market, and they're just not. We're moving into what I think will be the bubble phase of the stock market. And I've watched as just, trader after trader has destroyed their portfolios trying to short gold or short the stock market. And many of them are trying to short oil again. And I'm going to say that, generally speaking, there's just no reason at all to short anything over the next 3 or 4 months or 3 or 4 years, other than maybe the U.S. dollar. It's just too dangerous. Central banks are printing too much money. We've got bubble phases and probably everything ahead of us in the next 3 or 4 years. The correct strategy, in my opinion, is to forget about shorting anything. If you think something is due for a correction, which everything will correct. I mean, we just saw oil correct. It will correct, but don't try to catch that short side, because you risk getting caught in an upside surprise and doing serious damage to your portfolio. Just if you think something's going to correct, move your money over to something else that is going up, or sit on the sidelines and wait for the correction to run its course and then buy the dip. And I think if traders will follow that strategy over the next 3 or 4 years, it's going to be pretty hard to lose money.
Do you think in the gold and silver sector that all the pain over the last 5 years has seen the weak sisters sorted out, and now you take a look at the companies that survived that, most of them should be pretty strong?
I do, and I think the price of gold will be generally moving up over the next 3 to 4 years, and I think towards the end of that, maybe in 2020, and the reason I say 2020 is the dollar will be due for another 3-year cycle low. We've got one coming in next year in 2017, and that could push gold up to retest those all-time highs at at about $1,900 to $2,000. And then we've got another 3-year cycle low in 2020. So this is my reasoning for why I think the dollar has started another cyclical bear market. And I think that will drive gold into its bubble phase, and with the top maybe in late 2020 or even in the spring of 2021. That's my expectation, just based on cycles analysis and when the major, next series of major 3-year, multi-year cycle lows are coming due in the currency markets and the dollar. That should drive gold into its bubble phase during that period.
Do you see any particular currency replacing the U.S. dollar?
I don't. Actually, I think what we'll end up with once this is all said and done is a basket of currencies, because my theory for the last decade was that when this started, when the tech bubble burst and central banks decided to print money, cut rates, basically they are doing the opposite of what they did in the 30s, because we remember what happened in the 30s, the deflation of the 30s, and we don't want to repeat that mistake. So we're going to go 180 degrees in the opposite direction, and we're still going to have the consequences, but instead of deflationary consequences like it was in the 30s, I think it will be inflationary consequences. And my theory is that we're going to have rolling currency crisis, and all currencies are going to lose purchasing power, which will create bubbles, probably first in the stock market, and then I think in the commodity markets, with the major focus in the precious metals market when we get that final bottom in the dollar in maybe 2020. But I think it'll affect all currencies, the yen, the euro, the dollar. I think all currencies are going to lose purchasing power very rapidly compared to real assets.
Why do you think people have been obsessed with the U.S. dollar? We keep hearing about its demise, yet nothing seems to pop up that would replace it.
Well, there really isn't any currency that could take its place, so I think we're going to have a basket of currencies. But we've been talking for several months now, and I have been consistently fairly bearish on the dollar. And again today, even after the big employment report on Friday, the dollar has not been able to regain the 200-day moving average. And last time we talked, I said this is a pattern that you often see when a bear market is starting, is you'll get one or two really sharp moves below the 200-day moving average. That's kind of the warning shot across the bow. And then the dip buyers will come in, trading based on their perception of the fundamentals, and they'll recover that 200-day moving average once, sometimes twice. But then when it loses it again, and then I guess typically when you break an important support level after that second or third loss of the 200-day moving average, then you'll get a very hard move down, often something like a waterfall type event, and that is the recognition phase that everybody's on the wrong side of the market. The fundamentals are not bullish, and that we've got a bear market starting on our hands. And I think there's a decent shot we get that recognition phase maybe by September or October, when the dollar is due for its next intermediate cycle low, and that would be a break of the most recent intermediate cycle low. Let me look this up. I guess that was in August, right at about 95 on the dollar. No, let me get that figure for you, Jim.
Sure.
So let's see. It looks like it was at 92 back in, was it April or May? That was the intermediate cycle low. So I'm going to say that as this intermediate cycle rolls over and starts down, when we break 92, then I think that triggers some kind of a waterfall type event, which would be the recognition phase by everybody that they are on the wrong side of the market, that the dollar is not going up, it's not going to 110 or 120, that new bear market has started. And that's the point where everybody has to get out of their long position. So that's what I'm going to watch for in September, October. I think that's what's going to happen. I think we're going to break that 92 level, and that will be the real start of a bear market in the dollar.
Gary, thank you so much for chatting with us.
You're welcome, Jim.
My guest has been Gary Savage, President and CEO of SmartMoneyTrackerPremium.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be emailed to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.